Again, my name is Wesley Boudreaux, one of the financial advisors here with the Retirement Group. Today we're going to talk about some changes, and we're going to review the ExxonMobil 401k savings plan. Some of the changes that took place last year have been reinstated, and we'll also talk about some potential changes we could see in the future. Not just the Exxon 401k plan, but 401k plans across the nation if the Build Back Better plan does get instituted. Before I get started, I just want to remind everybody that the Retirement Group, even though we do a lot of extensive work with ExxonMobil employees, we're not employed by nor are we affiliated with ExxonMobil. And throughout the course of this, if you have any questions, there is a Q&A box. Go ahead and put your question in there. For limited time today, we may not be able to get to everything, but we'll be happy to follow up with any questions you have by reaching out to you. And there's also a chat box in there, so if you want to follow along, we'll be posting some information as far as how to get in touch with us, how to schedule a meeting with myself or one of the other advisors, as well as if you'd like to fill out a survey to let us know how we're doing, if there's any suggested topics or changes we should look at as well. And also if you want to reach out to us on LinkedIn, that's the best way to kind of follow us and get updated information on the ExxonMobil plans as they change, and also talk about the pension plan interest rates and things like that as well. So before I get started, just to remind everybody who the Retirement Group is. Again, we are an independent financial advisory firm that focuses on working with corporate employees and helping them transition into retirement. We've been doing this for just shy of 30 years. We've been working with ExxonMobil for a lot of that time as well. And by doing that and working with a select few companies, it allows our advisor to have a deeper understanding of your specific benefits plans inside and out, so we can hold your hand through that transition, making sure that you don't make any common mistakes we see from time to time. And with the Exxon plan, there's a lot of mistakes that can be made, and a lot of times even Voya makes those mistakes too, so we need to be very careful about, as you transition, how to do so appropriately so you maintain your stock, you reduce taxes and things like that as well. And one of the best ways to do so and understand if you can retire and transition appropriately is by running a cash flow analysis. This is something we provide complimentary, so if you haven't taken us up on it before, give me a call. We'll be happy to go through some questions and put that together to show you what your best retirement date may look like and look at alternatives and show you not just how it looks like now, but how it looks in 10, 20, 30 years down the road as well. And then also we've got offices throughout the country, so rest assured if you need to sit down with somebody face-to-face, even in these times, we can still probably accommodate that. But otherwise, you can reach us on the phone, or we can set up webinars to get business done as well. Now, as you transition to retirement, there's it's a big process for a lot of individuals. It can be daunting. So we've come up with a kind of a quick checklist just to keep in the back of your mind for that transition process. And at the end of the day, this is something you can do on your own, but we do recommend working with an advisory firm to kind of tie everything together that has experience in doing this, especially with companies like ExxonMobil. But first and foremost, you need to make sure you're comfortable with the actual transition process and comfortable with the investment strategy that you or the company you're working with puts together for you. So what I mean by that is there's two comfort levels, and you also have to have your emotions, understand your emotions essentially. We can run through that cash flow analysis and tell you, financially speaking, whether you can retire now or a later date, and give you kind of the A-OK that, hey, it's good to retire. But emotionally, you may not be ready. You may be, let's say, 59 and thought that you were going to work till 62 because you wanted to make sure that you had that start Social Security at that point in time. We can run the numbers and tell you, hey, you're in good shape. You can retire. You could have retired 2 or 3 years ago, but you may still be fixated on that age 62. Or you may not know what to do with your time. We've got a lot of individuals we work with that could have retired a year or two ago or even longer, and they're still working just because they simply don't know what to do with their time. And the flip side could be you're telling us you want to retire at 60 because that's what you've always said. We run the numbers and tell you need to work till at least 62 or 63 or maybe even 65. If not at Exxon, look at doing some part-time work. So we can run through all of that, but it's not just making that decision, it's being comfortable with that decision on when to retire. And then as far as once you do retire, you need to make sure that you understand the investment allocation options within the 401k or outside. You want to focus on hopefully decreasing your risk and volatility because let's face it, you don't have those years ahead of you anymore to make up for market corrections. You're now on a distribution strategy, not a contribution strategy, so it's very important to understand that. And then one of the best ways to actually do that is we need to focus on helping you increase your retirement income. We can do so by running the review, making sure you don't make any mistakes on the transition process, make sure you leave Exxon with the most benefits you can get. We can also make sure that we help you with that investment strategy so you continue to grow that portfolio while you're still taking money out. And then that also comes to the next point. We want to make sure you keep more money in your pocket. So we're going to help you eliminate the IRS 10% tax penalty on early withdrawals, and then also help you manage the taxes going forward. And let's face it, there's a lot of different changes coming forward with tax strategies, so it's really important to understand that. It's one thing to have good performance, but it's another thing to actually keep that performance. So we need to make sure we look at the tax strategies associated with the retirement transition process and well into retirement. And like I said, by working with the team, it's a lot easier to kind of cover, make sure you get all your I's dotted and T's crossed in this transition process. Now, let's talk about the savings plans. There's really two savings plans you have with the or 401k that you have with ExxonMobil. We're going to talk mostly just about the regular savings plan. There is a supplemental savings plan for those who are highly compensated employees. If you have questions on that, you do get your statement on there. Give me a call. I'll be happy to kind of walk you through it and let you know kind of the pros and cons and the ins and outs on the distribution strategies associated with that. But we're going to talk more about the regular savings plan that you have right now. Every employee will have. So first and foremost, contributions to it. Now, I've done a lot of work over the last 20 years with a lot of different 401k companies, and Exxon to this date is probably one of the best company matches I've seen. Now, unfortunately, we did go through that period last year from October 2020 through October 2021, where they actually paused and suspended match. That's back on now, so again, we're back to the norm. But that match, instead of a dollar for dollar, 50 cents on the dollar, like a lot of companies do, they're giving you more than a dollar for dollar on up to 6% of contributions. So if you make up to 6% contributions, they will actually give you a 7% matching. So you're putting 6% in but getting 13%. So this is very, very good. Now there are limitations we'll talk about in a moment as far as the investment strategies or investment options there, but that helps them keep the cost down. Where I also would go on a limb and say I think ExxonMobil probably has the cheapest 401k plan out there amongst all 401k plans as well. Now, on top of the 6%, you can also put in an additional 1% at a time, up to 20% contributions into your 401k, and you can make those contributions to the pre-tax, after-tax, or the Roth 401k options. The pre-tax is the classic allocation, in which case you make a contribution, you get a tax deduction this year on your taxes, and so eventually when you retire and take that money out, the contribution plus any earnings will be taxable. So you save taxes now but pay more later. The after-tax, a lot of individuals have taken advantage of over the year, is more kind of like a savings account, if you want to call it that, through the 401k plan, where that same contribution, maybe you make a $10,000 throughout the course of the year. Let's say you make $100,000 and you put in 10%. So in that example of that pre-tax, it looks like you only made $90,000 for the year because you get that deduction. But the after-tax, you still put the $10,000 in, but you don't get a deduction. So you are actually paying taxes on that full $100,000 for this year. But that $10,000 in that 401k, that cost base is going to remain that same. And in the future, if you want to access that for an emergency, you can take it out. Or you could theoretically take it out and roll it over directly to a Roth IRA. We'll talk about that in a moment, or a Roth conversion within the 401k and some of the potential changes there. But that can give you some tax-free growth down the road. Now that after tax, once it goes in there, that 10,000 example I gave you, the cost basis is tax-free, but the growth on it is going to be taxable as it grows. So let's say it grows from 10,000 to 25,000 over the next 15 years. That 15,000 of growth will be taxable eventually, but the 10,000 cost basis will not. Now, if you put that 10,000 in a Roth 401k, then all the future growth on there, assuming you stay, for 5 years and you're over 59.5 in the plan, then you're going to actually see a tax-free growth on that $10,000 in that example. So there's pros and cons to all these. Just give us a call. We'll be happy to kind of run through those with you as well. Now, we talked about the match, that 7% on the 6%. Just keep in mind, most of you there hopefully have worked for beyond 3 years, and you plan on working for longer than 3 years. Exxon's not really a short-term kind of job. But if you want to look at vesting, all your money you put in, obviously you're immediately vested for. It's your money. But the Exxon contributions, there's a vesting schedule of 3 years or age 65. So you have to wait at least 3 years before you get full 100% vesting on those contributions, that match they give you. Or if you start the company, let's say at 64 for some reason, some transition, that's only 1 year away before you're fully vested because you hit that age 65 as well. So let's talk about the Roth options that we mentioned before. There was the pre-tax contributions, after-tax contributions, and now more recently there's Roth 401k contributions you can make within there. Now, you can again make those contributions, and that's going to grow tax-free for you. Now, the other thing that you can do is you can look at Roth conversions within the 401k plan, or potentially Roth conversions or Roth rollovers outside of the 401k plan into an IRA, which is where the retirement group comes into play. on this as well. Now these are some things that could be in the works to change. We'll talk about in just a moment. But let's go back to that example. If somebody puts in $10,000 of after-tax money, what they can actually do right now is they can actually roll that over directly to a Roth IRA, or convert it to a Roth 401k within the 401k plan. Now that $10,000, that cost basis, since it's already been paid, there would be no taxes on there. Now, if it's proportionate, if there's earnings on there, the earnings would be considered could be considered taxable. So that portion would actually be taxed if you were looking to make a in-plan Roth conversion. So let's go over an example. Let's say over the years you've been building up that after-tax amount, and let's say you've got a $50,000 of what's called post-86 contributions. Those are your after-tax contributions in the plan. And for simple math, let's say that it's grown and that portion is worth $100,000. So essentially, if you look at that proportionally, about 50% of that amount is going to be tax-free, and 50% is going to be taxable earnings. So if you were to actually go in there and make a Roth conversion, either in the plan or outside to an IRA where there's more choices, and you can work with us on that, that $50,000, what would happen is $25,000 of it would be cost basis, so tax-free, and $25,000 would be taxable. So no matter what happened that year, it's going to show an additional $25,000 of income for you on that year. Now, even if you're below 59.5, there's no 10% penalty on this. So that's a good news about the Roth conversions and the Roth rollovers. So this is definitely something we focus on with individuals as far as if you can't qualify for Roth contributions, kind of a backdoor strategy where you can actually make contributions to the after-tax up to that 20% we talked about before, and then just turn around later that year and roll it over within the 401k plan or outside the 401k plan into a Roth IRA. Now, this is what can happen now, but there are some potential changes, and so far so good. Joe Manchin has actually kind of kicked the can down the road on the Build Back Better plan so far, so we'll see. It looks like it may be moving into 2022. But a lot of individuals were not aware of some of the different negative aspects of this. Obviously, there's a lot of changes and some pros and cons, but one of the big changes would actually kind of take the 401k world and the IRA world by storm, and not anybody's going to really mention it. One of the changes is the elimination of the backdoor Roth strategy, or the ability to roll after-tax money directly over to a Roth IRA, which is what I just went over and just mentioned with you. So there is potential this could end. We were thinking it could have ended in 2021. Now it looks like it may be 2022 if this does get through. If it does not go through, then fingers crossed, everything's going to be the same, and you continue to do this strategy down the road. One of my biggest concerns is I understand them trying to implement it, but it's going to be a logistical nightmare, because if they do implement it, then it's going to mean everybody has to keep track of their after-tax cost basis going forward for all their distributions if they commingle their money. If you have questions on this, let me know. The best way is to just give me a call, and I can send you a secure email, and we can get a copy of your Voya statement. I can look on there directly and show you what your after-tax balance is versus your post-86 contributions, run that breakdown for you, and let you know if you're retired or not retired, what your options are, and all the pros and cons associated with that as well. Another change that Build Back Better would be doing is actually potentially eliminating Roth conversions in the future, but that's going to be not till the 2030 timeframe, and it would be for highly compensated employees, those that are making over $400,000 a year or so. Now, keep in mind, we focus a lot on Roth conversions right now for retirees, especially between retirement and age 72, where your RMD starts to take place, because it's an easy assumption to think that tax brackets will likely go up down the road given all the spending the government's been doing. So what happens is at age 72, whether you need it or not, you're forced to start taking distributions from your 401k or your IRA, and you'll be at the liberty of whatever tax bracket you are at that time. So by reviewing things each year and doing Roth conversions, you can slowly get some of that money out of the 401k or IRA and reduce the amount you're forced to take out later in life, so you have more control of your taxes again, and you can manage those more appropriately. Now, we talked about the contributions and talked about the match and everything, but where's your money going within the 401k plan? Like I said before, ExxonMobil savings plan is probably the cheapest plan I've ever seen. But because of that, they're also one of the simplest plans. There's not much investment choices. It's primarily just some index funds you have in there. You've got the common assets, which is essentially kind of your cash plan, which is great because it's going to pay a lot more interest than what any other money market would do on the open market right now. Then you've got your index funds. You've got the equity units, which is going to follow the U.S. domestic market. You've got your extended markets, which is going to cover the small and mid cap. You've got your international units, which will obviously follow international equity index. And you've got your bond units, which follows the U.S. Aggregate Bond Index. And you've got the balanced fund units. Now this one, be aware of, it's a little bit different than what the name says. It's actually not balanced. It's actually about 75% stock exposure and 25% bond exposure. So it's more like a growth portfolio. So just keep in mind, if you're running your allocation, you say, I just want to be 50-50 or something like that and put everything in the balanced fund, you're not. You're going to be more aggressive than what you probably think you are. So if you have a question on that, let me know. And there's also the ExxonMobil stock we mentioned before about being able to make contributions there. And we'll talk a little bit in just a moment about the dividend options you have there, especially with the fluctuations we've seen in Exxon over the past couple of years. But it's also important to remember, I don't have it on this webinar, but we can go over it in person. On your voice statement, you do get your cost basis on that last 2 pages. So there's also something called NUA, net unrealized appreciation, which is a tax code option that may or may not go away in the future too. It's been discussed, but it's a way for you to actually save taxes and look at paying taxes on your cost basis of your stock and long-term capital gains on the growth. It's a little bit of a complicated strategy, but just give me a call and we can, again, with the copy of the statement, we can actually show you what your potential options are there. And those tax savings could be, if not thousands, tens of thousands of dollars for some individuals, and even much more in some cases. So again, any question on NUA, reach out to us and we'll be happy to help you out on it. And then as far as the ExxonMobil stock, we mentioned you can make contributions there, get company matched there as well. You also have the ability to, normally speaking, you just have those dividends rolled back over into the plan to buy more Exxon stock. But if you want to, you have the option to take those as direct distributions to yourself to increase your income if you want. But keep that in mind. It is going to increase your income. So if you don't need the money, it probably does not make sense to get those direct distributions paid out to yourself, because that is going to raise your taxes. So be very cognizant of that. If you have questions about the different options there, let us know. But again, if we focus on NUA, there's better tax treatment on the dividends down the road as well with NUA, because you're looking at long-term capital gains versus ordinary income as well. Now, as far as what we think the next steps are, obviously this is just kind of a quick overview of the 401k plan. For a lot of you, there's some transition options, especially if you're looking at retiring the next year. We didn't talk about it. We have other seminars and webinars that go over it, but the interest rates have dropped again for the first quarter of 2022. So if you're looking at lump sums and things like that and deciding when to retire, give me a call. We'll be happy to run through that and run that cash flow analysis to show you different retirement strategies. But just give us a call. Let us know if you have questions on your allocation of the 401k, if you need help there. If you have questions about the Roth conversions I mentioned and how to actually get your 401k to start growing tax-free for you and not just tax-deferred. But again, you can give us a call at 1-800-900-5867. We'll be happy to go through this. As I mentioned before, looking at running that cash flow analysis right now, the study shows there's still only about 30% of households over 50 actually have a written plan. That cash flow analysis I mentioned, it'll take us about it could be as short as 5 minutes or as long as 20 minutes of a conversation with you to gather some data, and then or we can always send you an email to get the data if that's easier. And give us about a week or so. We can put that report together and then set some time to go through it and show you if you are on path for where you thought you were, or uncover some additional changes or saving strategies you may want to focus on as well. And again, if you want to reach us on LinkedIn, you can hold your phone up to the screen. There's an option to follow us on LinkedIn to keep updated on any Exxon changes and updates on webinars we have coming up. And then also, if you'd like to schedule an appointment with myself or one of the other advisors, either in person or over the phone, or via web meeting, just go ahead and access our scheduling system here as well. And then I did say that we're going to, most of these questions we'll be happy to answer, follow up with you. But one question I did have from somebody was how do I actually, how much of my after tax can I convert to a Roth IRA or roll over to a Roth IRA? So this I talked about a little bit, but again, it's going to be a little bit different who you are. Let's go back to the example I gave you of let's say you've got $50,000 of cost basis and the after tax has grown to $100,000, and let's say your overall balance is $500,000. So in that you've got a $500,000 balance. $400,000 of that's going to be between pre-tax contributions and company contributions, so it's all tax deferred. $50,000 of it's your cost basis, and $50,000 of it's the growth from the after tax. So essentially, of that, $50,000 is tax free, and $450,000 is going to be taxable or tax deferred. Now, if you are retired, it's a lot easier. You can actually go ahead and separate that, and you can roll over the $450,000 directly to a rollover IRA. and the $50,000 go directly to a Roth IRA. So there's no taxes associated with that transition whatsoever. But now that $50,000 that Roth IRA will start to grow tax-free and not tax-deferred as long as you keep it there for at least 5 years and you're over 59.5. If you did nothing, kept that in the 401k or rolled it over to an IRA and didn't separate it, all the future growth on that's going to be taxable. So let's take that 50,000 example. Let's just assume it doubles in 10 years. By moving it to the Roth, that's 50 grand of tax-free growth. And just for simple math, let's just say, the tax brackets are, 10, 12, 22, 24%, but let's just say, 20%. That could save you $10,000 over that time period. Now, if you're employed, that's a different scenario because Exxon doesn't give you much flexibility. They do let you take out up to your cost basis. They can take out up to that 50,000, but it has to come out proportionately. I think I gave that example earlier where 25,000, which is 50%, would be tax-free, and the other 50%, which is another 25,000, would be taxable. So you could move that over, but in order to do so, it has to be proportionate. So you can't do the full 50. You can take 50,000 out, but 25 will go to a Roth IRA tax-free, and 25 will go to a rollover IRA tax-free, but will grow tax-deferred. So I hope that answers that question. But again, I just want to remind everybody, if you had questions, either email us at info@theretirementgroup.com or give us a call at 1-800-900-5867. We'll be happy to follow up with you on those. And again, the Retirement Group, we are not affiliated with ExxonMobil, but we've been working with them quite extensively. So any questions you have, not just on the 401k, but on the pension plan, healthcare, and things like that, give us a call. We'll be happy to help you out. I want to thank everybody for joining me today and hope you have a happy holidays.